Hi there, this is the second recording of the Unit 3 BTEC Personal and Business Finance revision session. This one focuses just on the business finance. So as you know, the exam is split into two parts. I've got a separate video for the personal finance section, and this one, like I say, just focuses on business finance. Important to note that the exam is 2 hours long. You should be spending approximately 45 minutes on the personal finance side of things and 1 hour 15 minutes on the business finance side of things. It's slightly longer and it is worth more marks to you, the business finance. It's important to revise, and I'm going to go through everything that you need to know coming up. So before we start the presentation on business finance, let's just have a quick look at what is the difference between personal and business finance, so we're quite clear. So personal finance does exactly what it says. It deals with a person's personal finances. So if you have a job, you're going to be earning money from that job, or if you have savings, you might be getting interest on those savings. That means you'd have some money coming in, and it's how you deal with that money on a sort of personal level. The main thing to understand from personal finances is that you have money coming in and likely that you will have money going out, and those sort of things that go out are things like your mortgage or your rent and your gas, electricity, car insurance, home insurance. The list is endless of different personal finance expenditure. And of course, it's basically the money that you're left over with each month or each week or each day. That is what you would call your disposable income, the money that you have left over. And the thing to understand here is that, of course, businesses are no different. They are dealing with money, so they have a flow of money, the money that comes in, money that goes out, because of course they also have expenses. They also have to pay rent or mortgages, business rates, water, gas, electricity, all of those kind of expenses as well. And of course, like the disposable income that a person has left over, the money that's left over in a business once they've paid out all their expenses is what you would call profit. And that's the kind of main difference there. So I just thought I'd quickly mention that so we have an understanding of the difference between personal and business finance. So these topics that I'm about to show you have been covered already in my other video, but this is what do I need to learn. These are the topics. So these are the ones for personal finance. So you've got section A, understanding the importance of managing personal finance. A2, the different ways you can pay. A3, current accounts. Again, all of these are covered in my other video. Okay, moving on, we've also got A4, managing personal finance, is that section. And section B starts to look at exploring the personal finance sector. So just to finish up on the personal finance side of things, you have B3, consumer protection in relation to personal finance, and B4, information, guidance and advice. So all of the things I've just shown you, those are all the topics that could come up in your personal and business finance exam. We now move over onto the part of this video which is the business finance, and we start off with section C, understanding the purpose of accounting, looking at C1, purpose of accounting, and C2, the different types of income. Nice easy topic, that one. And I'll go through all of these in the video, so stay with me. I'm just going to really covering what topics you're doing at the moment. So next topics are as follows. Now I like these topics because they seem to be the easiest. C3, the different types of expenditure, very easy topic. I'll be covering that shortly. And section D, sources of finance. Again, nice easy one. Some complex stuff in there, but easy topic to understand. Next up, we move on to section E, which is the break-even and cash flow forecasts. And E1 focuses around the cash flow forecast, and looking at inflows and outflows and how to construct a cash flow forecast. And then E2 starts to look at break-even and break-even analysis and costs and sales and various other calculations in relation to that. Then finally, section F focuses around statements of comprehensive income and statements of financial position. So quite complex stuff, Quite a lot to absorb and quite a bit of information in that. Then F3 looks at measuring profitability, F4 looks at measuring liquidity, F5 measuring efficiency, and then the limitations of those ratio uses. So again, quite a lot in there, quite a lot of formulas to remember, and I'll talk all about those in this presentation. So before we have a look at those business topics, let's just have a quick look at some information from the exam board so we understand where we're going. This is what the exam board want in terms of a distinction. Have a read of that yourselves, and don't get too confused or put off by that. A lot of it is sort of exam jargon really, but it's really asking you to demonstrate and show that you have a sort of full understanding of all of the topics. And one of the things that I always think when it comes to the topics is that if you say pick a topic, let's say insurance, for example, that's to do with personal finance. If you understand what it is, the topic is, why it is used, and the advantages and disadvantages of that. So let's just say car insurance. Why do we have car insurance? What are the advantages of having car insurance? What are the disadvantages of having car insurance? Then you're kind of halfway there to having a level of understanding, because the examiner's really looking for your thorough knowledge, if you like, and you know that you can relate to real life situations. So have a read of what it says there, but don't be too put off. But it is trying to give you some guidance there as to how to get a distinction. And we've mentioned also about grade boundaries in the other video. So, you know, do remember, go back and watch that and see what it is that you need to do to achieve a distinction grade. Command terms, these are quite useful understanding, because sometimes when you see a question, you see those kind of words, you might get yourself in a bit of a panic. What does that actual word mean? Analyze, assess, and calculate. Well, it's kind of got a definition now. I think it is important going into the exam to have an understanding of these terms. There's a few more as well, just to help you along the way, and obviously by telling you, this is from the exam board by the way, by telling you what the command words are, they're also giving you an indication of what the question's going to be, because these are the command terms or words that they use. So familiarise yourself with them, and it will definitely help you going forward. And you need to understand what's meant by the term describe, discuss, evaluate, explain, give, identify, illustrate, and outline. All have different meanings. So if you have an awareness, that's going to definitely put you in an advantage. So this is a really useful page. This is all the formulas that you need to know going into the exam. Now, don't be too overwhelmed by it. Some of them are really obvious, and obviously some are a little bit more complex. However, the important thing to note from these formulas, as I mentioned in my other presentation, is that there's nothing more complicated in here than multiplication, addition, subtraction, and division. If you look at that, so there's nothing more complex than that. Yes, there is quite a bit to learn. You're probably only going to be tested on maybe, it's hard to say, but probably about 20% of what you see in front of you there is probably where you're going to be tested on. However, they're kind of indicating that you do need to know all of it. I would imagine it's quite hard to remember all of these, but some of them are pretty obvious. And I think when you go into the exam, so for example, if you had a question on revenue, I'm looking in the green section here, unit price versus multiplied by quantity sold. Obviously that's very simple calculation. So if you had 10 cans of beans selling at 50p a can, obviously what is the revenue? Well, of course the revenue would be £5. So some of them are kind of really obvious, and obviously some of them are a little bit more complex. Important thing to note though from this is, of course, when you're doing these questions, make sure you show your calculations and your workings out, because the questions are going to be worth more than 1 mark. You might get a question that's worth 3 or 4 marks. If you just put the answer, the examiners are only going to give you 1 mark, and you've just lost or missed out on the opportunity to gain a few more marks there. So make sure that you do show your workings. And of course, even if your answer is wrong, but you've gone along the way and you've tried to make some kind of attempt at doing the calculations, then the examiner may award you a mark for having a go. So really important that you have a go at the answer, of course, and also your workings. So the first section on business finance is the purpose of accounting and why do businesses need to do accounting. Comes under section C, C1, purpose of accounting, and there are 5 main reasons why businesses have to do accounting. Number 1 is recording transactions, what's going in and out of the business. Have a look at that in more depth. Number 2 is the management of the business. If you're a manager and you're in charge, if you've been doing your accounting correctly, it does help with business planning, monitoring and controlling of the business. There's also this thing, number 3 is about compliance. So there are laws and rules and regulations in this country that certain businesses will have to do some accounting and report back. So it's important also for tax purposes, things like that. Number 4, accounting does allow measuring performance, how well your business is doing at any one time or how well it's performed over a period of time, for example, a financial year. And also finally, number 5, control. It allows you to track your trade receivables and your trade payables. And if you're not familiar with those terms, you will be by the end of this video because it pops up again. But do take a note of that. Try to remember those 5 reasons for the purpose of accounting. So next up is types of income. And that focuses around C2. And it's important to note that there are 2 different types of income. One's called capital income, one's called revenue income. So let's have a look at those. So what does the actual word income mean? Well, income is the money received by a business. So exactly what it says, money coming into a business. And capital income, so that's different to revenue income. Capital income, this is money used to set up a business, getting it started. It's a long-term investment, and examples of capital income include the following. Make sure you read these links so you do understand, but of course somebody could take out a loan. That would be capital income to get their business started. Somebody could take out a mortgage to perhaps buy some premises like a shop or a factory to get their business started. Debentures, which is a type of bond issued by large companies. Owner's own capital. So if you had a sufficient amount of money, you could put your own money into the business. That would be considered to be capital income. And also shares issued by companies to shareholders to raise money as well. And that's how you kind of get your business set up and running, capital income. Then imagine that the business is now up and running. So you move over to something called revenue income, and this is the income received by business on the sale of its goods and services. And there's various things and various ways that they get money coming in. So you could have the obvious one, cash sales, people coming into your shop and buying goods or using your services. Credit sales, again, through the sales of method of using credit. Rent received, so for example if you had a shop and it had a flat above it and you were renting out that flat above, that could be rent that you're receiving for renting that flat out. That could be revenue income. Commission received, interest received, money on savings. So as your business grows and you put some money aside from your profit into your business bank account, you're going to get interest on that money. So that's considered to be revenue income. And discount received. So do take a note of these, read all what they say, make yourself aware of the 2 different types of business income. Okay, so we just looked at different types of business income. Now we're going to look at the different types of business expenditure when businesses have to pay out for things. So 2 types, there is capital expenditure and revenue expenditure. So a bit like capital income and revenue income. Now we're looking at capital expenditure and revenue expenditure. Here's capital expenditure. Capital expenditure, these are assets, capital items that the business plans to use over a long period of time. There are 2 types of assets, non-current assets, tangible and intangible. So let's have a quick look at what those non-current assets are. Things like land, buildings and premises, machinery and equipment, vehicles and fixtures and fittings. And then capital expenditure, intangible assets, goodwill, patents, trademarks and brand names. There you go. So do have a read up as well of what it says below on intangible assets and something called depreciation. It's something again that you need to be aware of. But capital expenditure. Then we move over to the next one, which of course is the revenue expenditure. There's a big list here, and I suspect that you're probably not expected to know all of them, but to be able to list maybe five, remember them for the exam, will probably see you through. Just having a look at the different types of revenue expenditure that's out there. So let's have a look at some of them. So rates, pretty obvious one. Business tax on non-domestic property use, used to fund local council services. Heating and lighting, obviously if you've got business premises, you've got to heat it, you've got to light it, you've got to pay for it. Water as well on your business premises, you're going to need insurance if you have a building. Administration, paperwork, you probably have to pay for that. Telephone costs, postage costs, stationery and printing costs, salaries you're going to have to pay out. If you've got people working for you, you're going to have to pay them. And you're going to have to pay to advertise and market your business and products and services. So marketing is also considered to be a revenue expenditure. Reduced balance depreciation and straight line depreciation is something that we look at as well. There's links on there for further stuff, so we'll talk about those again in this presentation. Wages as well, bank charges, interest paid, discount allowed, inventory, you've got to buy your stock in of course, and then rent, you may have to pay rent on premises. So that's a big list of all the different types of revenue expenditure that businesses face. So like I say, you'll probably need to remember a few of those because that could come up in the exam. Give examples of revenue expenditure. So next up is the sources of finance, and sources of finance is basically where do businesses get their money from, and there's two types of sources of finance. They're what you call internal sources of finance, where the business will look within itself to find out if they have any money that they can use for whatever reason it might be. Also, there's the external sources of finance where the business will look outside of itself and see if they can obtain money that way. Let's look at what that means in a bit more depth. So internal finance. So if a business wants to expand, for example, or if they need to pay for something, they might first of all look internally and say, right, what money do we have first of all? Number one, they might look at their retained profit. Okay, so money that they have saved from previous years might be put aside that they could use. They would look at number two, net current assets. This is money that is immediately available to the business, e.g. cash. So they might have cash and that they have in their sort of day-to-day business current account that they could use. And of course, they could consider number three, the sale of assets as well. So if the business has vehicles, buildings, machinery or equipment that could be sold to give the business cash, something that a business would possibly consider if they're no longer using certain vehicles or a building's redundant, they can raise money that way by selling their assets. So they look at internal finance maybe first before they go to the external sources, but that covers the internal finance and you should be able to explain what they mean. So do have a read of what it says there on that page as well. Then we look at external finance, number one. We'll try and go through these, but as you can see, there's a lot of detail on here. So please do pause the video and have a read of what it says on this sheet. I'll just quickly summarize what some of them are. So if a business doesn't have any money internally, they will then turn to external sources and start to think, right, where can we get money from? One of the most obvious ones is, of course, a loan from the bank, where they might approach the bank for a loan, and that means borrowing some money, normally a set amount of money, and repay that money over a longer period of time, paying a little bit of interest as well on top of the money that they're borrowing. Crowdfunding is a sort of new method or new way or newish way of raising capital, raising money. Venture capital as well, do have a read up on that, similar to crowdfunding but not quite. Mortgages, okay, normally again go to a bank for a mortgage. That's a long-term loan to enable you to buy business premises like a factory or a shop or something. Debt factoring, have a read of that. It is important that you understand that. That's about where a business sells its invoices to a third-party business and they give you the money. So have a read up on that. And of course, hire purchase. And owner's own capital is also considered to be an external source of finance. Again, perhaps you might not need to know all of these, but it is important to have an awareness what each one means. You never know when you're going to get a question on it. And we move on. There's a few more as well. Trade credit. The business has use of goods immediately and pays the supplier. So that means where a business will do business with another business and the other business allows them a bit longer to pay for the items, normally like give them sort of 30 to 90 days of what they call trade credit grants, normally issued by the government. Have a read of those. That's important. That's another external source of finance. Donations could be another possibility. Something quite new in the last sort of 10-15 years, peer-to-peer lending is another external source of finance. Invoice discounting and leasing, they are all different types of external source of finance. Okay, so do have a read up on those. Again, important to understand what they are and the sort of scenarios to when businesses might use that particular source of finance. So next up is the one to talk about is cash inflow and cash outflow. And it's as simple as it sounds. We all have money that comes in and we all have money that goes out. So for example, I have money that comes in through my salary and that's my inflow or my cash inflow. And then I have cash outflow, which means other items that I need to pay for example, mortgages, food, insurance, gas, electricity, and all of those kinds of items. So money that comes in, money that goes out. And the thing to say is that businesses are no different. They also have money that comes in and money that goes out. And that leads us on to section E, which focuses around break even and cash flow forecast. But let's have a look at what the sort of real definition is from a business point of view of cash inflows. Cash flow forecasts aim to predict money flowing in and out of a business to ensure it stays solvent. I'll talk more about cash flow forecasts in just a moment, but let's have a look at examples of what are cash inflows. So you could have what's called cash sales from goods or services paid. So if you have a business and you sell a product or you offer a service, you're going to get cash sales. Credit sales, goods and services paid for in the following purchase way, e.g. a credit card. Loans, so if you get a loan from the bank, that is still considered to be a cash inflow for the business from an external source, as it mentions there. Capital introduced, funds invested in the business by the owner or shareholders. That's capital introduced. Sale of assets, money received from selling an asset. So for example, machinery. So if you had a factory and you wanted to get a bit of cash, extra cash in, and you didn't use that piece of machinery anymore, you could sell that asset and that would be a cash inflow into the business. And then bank interest received. So just as an example, if you had £25,000 of your business money sitting in a savings account, a business savings account, likely the bank would give you a little bit of interest on that money and they would pay that into your business bank account monthly, and that could also be considered to be a cash inflow. Then also we have some other cash inflows, or some other information I should say about cash inflows. Cash and credit purchases, anything a business buys is an outflow, whether it is used by the business or for resale, e.g. raw materials and stationery. So that's important to understand. Rent, rates, salaries, wages and utilities, they are all regular outflows, money going out of the business. The business must have cash to cover these, so that's really important. You haven't really got a business if you can't pay your rent and your rates and salaries and wages, because if you can't pay your salary and wages and your suppliers, you haven't really got a business, because your staff are going to walk out and your suppliers are going to stop supplying. Other examples of cash outflows is cash purchases, credit purchases, rent, rates, salaries, wages, utilities, purchase of assets, value added tax, VAT, and interest paid to the bank perhaps on a loan. So the opposite of this one is that you're paying interest on a loan that you might have. That's considered to be another outflow. So that's the difference between a business inflow and a business outflow. So here it is then, an example of what a cash flow forecast looks like. And it is important to be able to recognize what a cash flow forecast is and how to read one and how to read one quite quickly. But let's have a look at this one. So you can see that this is an 8-month cash flow forecast. Why can I see that? Well, I can see 8 months above on the screen there, January to August. So that tells me it's an 8-month cash flow forecast. Also tells me it's incomplete at the moment because it's only being completed for the first 2 months of the year. Now remember, as mentioned already, what a cash flow forecast is. It is just a prediction. It doesn't necessarily mean that is what's going to happen. It's just a business trying to predict the money that's going to come in and the money that's going to go out of its business in the forthcoming year or in the next 6 months, depending on how long they're doing their cash flow forecast for. They're really useful because, of course, it does enable the business to identify large expenses that might come out, or a large amount of money perhaps that might come in, and then you can decide what you're going to do with that money. Now normally on a cash flow forecast, as you can see under January there, you normally do the inflows first, so that means the money that's going to come in. So let's just pretend for a moment this is a shop, and in January they've got sales of £30,000 that currently don't have a bank loan, but they are receiving £400 interest on their savings. Now, as mentioned in the previous slide, interest on savings is considered to be an inflow, so that will also go on the cash flow forecast. And then they have a shop, they have a flat above the shop, and they're receiving rent from that, and that's £1,000. So they have a total cash inflow in January of 31,400. So that's the money that's coming in. That looks healthy, that looks good. But of course, with any business, if you've got money coming in, you're also going to have money going out. And they have the following outflows in January as well. So they also have to pay rent for the shop downstairs, £1,200, £400 on gas, £400 on electricity, £200 on water rates, £45 on stationery, and £230 of an old loan repayment. So they have total cash outflow of £2,475. Now, I think the healthy thing to say and see here is, of course, that January looks good because, of course, they have more money coming in than they do have going out. So things are good. And at the beginning of January, they had £25,000 in their bank. That was the opening balance in January. So, of course, once you put the money that's coming in and take off the money that's going out, and then add that to the £25,000 that's already in the bank account, then you're left with a balance of £53,925. So the business is looking in a good position from this cash flow forecast in January. Now, of course, you'll recall from previous lessons that whatever your closing balance is in January, then that carries over to become your opening balance in February. So you've got the same figure there under opening balance, 53,925 in February. Now, of course, February starts trading. And we can see also another healthy month of sales, £32,000 coming in sales for this particular shop. No bank loan, more interest and rent from the flat above the shop. Again, that's another bit of income. And the total cash inflow for February, again, very healthy, £33,400. Cash outflows then for February, very similar to January. This month's cash outflows, in fact, are the same as January, £2,475. Now you take that away from the cash inflows, and you can see that the opening balance of 53,925 has now grown to a closing balance at the end of February to 84,850. Again, very, very healthy. And you can see that carries over into the opening balance of March. Now this again, just remind you that obviously it's just predicted. It doesn't mean it has happened. It doesn't mean it's going to happen. It's just a prediction, and it's a good way the business can look at all possibilities for the coming year or the coming 6 months. Cash flow forecasts, very useful way of looking at your business. So the next topic focuses on costs and sales, and a topic called break even. I'll be honest with you, this is where the syllabus starts to get a lot harder. And this is the point where I highly recommend doing additional reading, watching some YouTube videos, speaking to your teacher, trying to find additional resources, exercises, to try and complete with these topics, because all of the topics that are now remaining in the syllabus are actually quite complex. So you definitely need to do those additional things that I'm recommending. But anyway, we focus now on E2, break-even analysis, and it looks at the topics that are listed there. And obviously we start off with costs and sales. And I've also a quick explanation as to what break-even analysis is. So break-even analysis identifies the point at which business's costs are matched by the money it receives from sales. Below this point, the business is losing money, and above the point, it is making a profit. In very simple terms, break even means that it's the point where a business will receive back the money that it's put in. So let's put it into context as well. If I walk into a supermarket and I spend £30, say, on hot dogs, like for example rolls, ketchup, sausages, that kind of thing, and I come out of the supermarket, I am then £30 down. If I then go on to go and sell those hot dogs, and I sell those hot dogs at say £2 each, I will then need to sell 15 of them to get my money back. And at that point I have broken even, because I put in £30, I got my £30 back by selling the hot dogs at £2 each, and I've got to that point. If I only sell 14, I've run at a loss, I'm £2 down, because I would have only received back £28 of the £30 investment. If I go on to sell 16, I'm then in what we call the area of profit, because I've then made a £2 profit. That's a good way of looking at it. It's a nice simple term in terms of understanding break even. So break even is when you get back the money that you've kind of put into the investment. But it's a bit more complex than that, but I wanted to give you a sort of simple explanation. Anyway, the page on here just talks about costs and sales. Obviously a business has costs and it's going to have sales, and it's got a total revenue formula there on that sheet for you, and also the break-even point as well, and how to calculate that. So again, important stuff that you do have a read of the details that are on there, and important to have an understanding of the difference between fixed costs and variable costs. So a fixed cost is an amount that doesn't change. So you could argue that your rent, perhaps as a business, that you pay is an equal amount each month. That's what we would call a fixed cost. And a variable cost is an amount that changes and is variable, of course. An example of a variable cost, so for example, if I ran a sandwich bar, and I was obviously making sandwiches, the quantity of bread I might use per day or per week, per month, may vary, and it might be various factors that would determine my use of how much bread I need. It could be implications of the weather or how much people are spending at the moment, that kind of thing, but it'd be a varying amount, wouldn't it, depending on the number of orders that are needed. So one day I may need 10 loaves of bread, the next day I may only need 5 loaves of bread. So it's what we call a varying cost, because it varies all the time. Anyway, and then of course it looks at sales, and it looks at what we call the selling price per unit. Sometimes that word can be confusing. What does it mean by per unit? Per unit means one item and one particular product. So you could take any item. So let's say 10 iPhones, for example, that would be considered to be called 10 units. It's just a business term that business people use to understand their stock. So a unit is one item. Then we look at the next page. Again, lots of detail on here, so do spend a bit of time, pause the video, have a proper read of this so you really understand it. Break-even analysis, and it says you need to revise how to calculate a business's break-even point using both the break-even formula and a break-even chart. Now hopefully you've done some work on break-even in your lessons, and that you started to understand it, but there's some example formulas on here, so do take a moment to have a look at these. Very important. And also there's a break-even chart. Make yourself aware of it's all labeled, so make yourself aware of all the different areas on the break-even chart. You never know, you might have to label one in the exam, and it is important to understand it. And if you look at my example I just gave about the sandwiches there, so you can see that blue area where it says loss in the bottom left hand corner there, that's where I haven't sold sufficient hot dogs. Then it gets to that break-even point, and then of course if it goes beyond there I go into that area of profit, and that's where I'm making more money. So just don't get too confused by a break-even chart. Do speak to your teacher if you're still confused by this topic, though, because it's easy to understand, but it's one that you need to spend a little bit of time with to really truly understand, and also the formulas that go with it. Then, of course, it says using break even. This is important because you could get questions on this. And it's saying about, giving you some explanations as to why businesses perhaps use break even. And this is the stuff that you need in a larger mark question. So spend some time on this, reading it as well, and also looking at that other topic of what's called contribution and the benefits and limitations, because you could get a question. What are the benefits and limitations of contribution when using break even? So again, stuff to read on this sheet as well. So we move on to the next topic, which is a statement of comprehensive income, looking at this area of the syllabus, F1, the statement of comprehensive income. And we start off by looking at the details in the book. Do pause the video and have a read of this, because you have to understand what the purpose and use of a comprehensive income statement is, how to complete one, perhaps how to do the calculations, how to do an adjustment for depreciation, which is something that falls in value, adjustment for prepayments and things like that, and analysis and evaluation as well. So do take a moment, pause the video, have a read of this particular screenshot, because this has got some vital information that will help you understand what a statement of comprehensive income is. Now, if you're thinking what actually is a statement of income or comprehensive income, it is at the end of a financial year. A business produces a statement of comprehensive income, which includes a statement of profit and loss, and it records sales and revenue and expenses and shows how much profit or loss the business has made that year. On this page, you will revise the various elements of an income statement and how to calculate gross profit and profit or loss. So again, do take a moment to have a look at this. And here is a good example of a statement of comprehensive income. So it shows the money that the business has made, as in sales, the money that has come in, and then of course all the money that has gone out. And of course the key point of this comprehensive income statement of income, of course, is the bit at the bottom there. Has the business been profitable? That's where the eyes will first go, just to see how much the business has made, or if it's running at a loss. But that's it. That is a statement of comprehensive income, something I highly recommend that you practice in class, read up on, watch YouTube videos, and go back and quickly read the page that was showing on the slide previously. So next up is statement of financial position, and we've just looked at income statements, and now we move on to this one, which is the statement of financial position. Important to say that this is quite a complex subject, so you do need to do some further investigating and reading up on this, and I recommend speaking to your teacher, watching YouTube videos, and actually completing statements of financial positions as well, because it's going to be definitely one or the other. The comprehensive income statement is going to come up, or the statement of financial position is going to come up, and it's worth 7 marks to you. So important that you do understand this and get this right. But a statement of financial position is also known as a balance sheet, and it shows assets and liabilities of a business, plus a whole host of other things as well. But you can pause the video and have a proper read of this. Remember, this video is just demonstrating and talking to you about what's going to potentially be in the exam or what's on the syllabus, so you do need to do some more research on this, because this is a key point and something that you need to practice. Also, the statement of financial position talks about assets and liabilities, and it is important to understand what an asset is and a liability. So an asset is something that the business owns, for example, building or machinery or cash in the bank. And assets are divided into something called current assets and non-current assets. Okay, so you do need to understand that, and if you have a read of that sheet there, it does explain to you the difference there between a current asset and a non-current asset. And then you've got current liabilities and non-current liabilities, and that's basically what the business owes to others. Okay, so for example, a mortgage. So if you've got a mortgage on a building that you own, then that's got a liability because you owe the bank some money. And it moves on to giving you an example of what a statement of financial position looks like. Again, please do watch a video. Tutor to You do brilliant videos and explanations on statements of financial position. So have a look at his explanation because it goes through it in quite a lot of depth. And there's some calculations to kind of work out there. And so you can see it starts off talking about the assets and what the kind of how much the assets are actually worth in total, how much the business owns in terms of its assets, and then also how much the business owes in terms of its liabilities there. So you can see this particular business or financial statement of financial position has total assets of £39,000 odd, and then has liabilities of how much it owes of 25,000 odd as well. And then you have what they call net assets, the difference between those assets and those liabilities. That's what's remaining, and it's a positive figure in terms of this one, 14,735. So it's a positive figure, and then it talks about how the business is made up of in terms of its share capital, retained earnings and total equity and things like that. But again, do watch another video on this. Also, a statement of financial position, number 3, lots of information on there, lots of bits of terminology, prepayments, accruals, calculations to look at as well, and also something called depreciation, as how your assets do depreciate in value over a period of time. So for example, if you went out and bought a brand new car for £10,000 today, in a year's time, of course, you've been driving that car around for a year, it's not going to be worth £10,000, is it? It's going to have depreciated in value depending on the amount of mileage you've done during that period of time. But wear and tear will also make part of that as well. So that is the statement of financial position. Do download some exercises on it. You do need to practice this, and it's worth 7 marks to you. So something that is essential to practice on. So next up is something called measuring profitability. And obviously, as you'll know and be aware, that if you have a business, one of the objectives could be to make a profit, make money, and with that profit you can then expand your business perhaps, or just take that profit because you've been working hard. Depends on what you want to do with that. But businesses like to measure their profitability. They like to have calculations they throw in because they want to know that the business is profitable. Very important. So we're focusing this time on F3 part of the syllabus, measuring profitability. So it's calculation, interpretation and analysis of the gross profit margin, markup, profit margin and return on capital employed. Again, something that you need to practice in class because this should really come with some worksheets, and I recommend the Two Teachers calculations workbook. Hopefully your teachers downloaded that because that is very, very useful for this particular section. Gross profit and markup. Businesses use 4 profitable ratios to measure how well that they are performing, and on this page you will revise gross profit margin and markup and how to calculate them. So gross profit margin, this enables a business to work out how the gross profit on goods sold after deducting their costs. Gross profit is measured as a percentage of revenue. Markup. The markup is a percentage added to the cost to create the selling price. So for example, if you let's say you make speakers and they cost £40 to make those speakers, you're going to maybe add a £60 markup to the value of that and sell those speakers, say, for £100, and that's the markup price on your product that you've made. A couple of formulas there to look at and a couple of worked examples that you should pause the video on and have a look at as well, on how to do the gross profit margin formula and the markup formula as well. Next up is profit margin and return on capital employed. Net profit margin, this ratio measures the profit made by the business after all expenses have been deducted. So the net profit, that's the key figure, the ones that businesses like to look at the most. and return on capital employed. I always find this one a little bit confusing, okay, but go with it. So investors and owners put capital, as in money, into a business in the hope that this will enable it to make a profit. So if you own a business, you might put some money into it, okay, known as capital, or you might get some investors to invest in your business. From this profit, investors expect a return, as we mentioned, and the ratio measures the return on capital as a percentage of the capital employed, and it shows how efficiently the business uses the money invested. So quite a useful figure actually with regards to that. And again, on this sheet you can see the two formulas that you'd be expected to know, and also two worked examples. They're nice and easy to follow-ish, but again, you should be practicing this in your classes. So our next topic is, of course, measuring efficiency. And our businesses are constantly measuring how efficient they are, especially in comparison to other businesses, and how they can make themselves more efficient. It's a big topic these days. We focus around F5 on measuring efficiency, and under F5 there's the ratios of efficiency, the three that you see there in the purple box: trade receivable days, trade payable days, and inventory turnover. But as you can see, so don't panic too much, quite simple maths there really. One number divided by another number multiplied by 365. Let's have a look at some examples from the book. So trade receivable days, this ratio measures the average number of days debtors take to pay their invoices. So that's people that owe the business money, and the formula for that is trade receivables divided by credit sales multiplied by 365, and it gives you a calculation example on the right there. So do pause the video, take a look at that example, and could you work that out as well? You should be able to, shouldn't be too difficult. And then you have what's called trade payable days, similar sort of calculation, but this ratio measures the average numbers of days for the business to pay its suppliers, their creditors. That's people that they owe money to, and that's trade payables divided by credit purchases multiplied by 365. And again, worked example on the right. And then finally, the last one, inventory turnover, and the formula for that is average inventory divided by cost of sales multiplied by 365. And this ratio measures the average numbers of days a business holds its stock, or inventory as they sometimes call it, and it helps it to determine when to reorder. When a business uses its perishable supplies, inventory days will be low. So again, that's important to understand as well. But there you go. That's the three formulas that you would need to know under the section F5, measuring efficiency. So the last section of the syllabus is this, what we call limitations of ratios, and it's down there at the bottom. It's the final bit. It's F6, just that bit in the purple box there. So there's only 1 point to remember, and only really 1 page from the book. The important thing to note from this is what are the limitations, the disadvantages, if you like, of using ratios for a business. You do need to know this, even though it's 1 point. It could come up in the exam, possibly might not. But again, you probably do need to know it. So I'd say to you, if you can remember at least 3 or 4 of them going into the exam, that would be helpful for you, just in case a question came up. For example, discuss the limitations of the use of ratios in business, that kind of thing. So anyway, let's have a quick look. There's 6 of them according to this book. So ratios are averages. So that's the first point, which is relevant, I guess, and obviously expand on that a little bit. Ratios highlight problems but don't explain them. So when you're working with figures and you've got a ratio, it might all be very well that you can see that ratio in front of you, but there's no actual explanation as to how it's got to that point. Also, ratios are based on data which may have changed. The figures come down from the statement of financial position which values the business at a specific point in time and may no longer be relevant. So that's also another significant point. Accounting practices is number 4, used by the business may distort its performance. Okay, so that's again another limitation. Number 5, it may be difficult to compare ratios with those of competitors. All right, so again, that's another point. And the final point, poor performance does not always mean that the business is failing. The market may have been very competitive and lower profits may have been expected at that point in time. So there you go. Like I say, only 1 point, as in the 1 section to do for this particular area, F6. But that covers it. But pause the video and have a proper read of it yourself. And like I say, if you can know 4 or 5 of them, or 3 or 4 of them rather, that should be sufficient to kind of get you through any question that may occur. So that's the end of the topics, the end of the syllabus for the business finance. Just one final section just to quickly go through, something that's very useful in the book. And you can pause the video and have a look at these yourself, but it's just that kind of Unit 3 exam stuff and preparation for the assessment. One of the key things to any exam is preparation, but the last few pages of the book just basically goes through the different types of questions and those terms that they use for exam questions. So give or identify questions, got some pointers there. Describe or outline questions, explain questions, again pointers. You can pause the video here, have a proper read of what it says on those pages. Discuss questions, how to answer those and things to consider. Calculate questions, remember always show your workings in calculation questions. I'm sure that reminds you on this page to be able to do that. Analyze questions and how to do those. Assess questions and the things to consider when an exam says assess something. And then finally, evaluate questions, the evaluation questions. So could be useful to you. I recommend just pausing and having a read of it. And that is it. That's the end of the presentation. I will do another video on a whole paper walkthrough, so look out for that. That'll be coming out soon as well. But I hope that you have found this presentation useful, and I wish you all the best in the exam.